Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Pillar 2 to U.S. tax reform. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're at PwC's EMEA Tax Academy in Prague, Czechia, where I'm thrilled to welcome Tom Patten back to the podcast. Tom is a London-based U.S. international tax partner at PwC, where he focuses on inbound investment into the U.S. Tom, welcome back to the podcast.
Thanks for having me back.
We are a long ways away from St. Louis, where we recorded our first podcast a couple of years ago. So it's fun to be over here in Europe, recording sort of on your home turf, or well, somewhat close. But before we dive into Section 891 and 899, and we usually don't use code sections here on the Cross-Border Tax Talks podcast, but this is a code section that people around the world are talking about. I've got to start with a question about baseball, Tom.
All right.
You know how excited I am. It's baseball season, right? The Major League Baseball has started. We have 160-ish games to go, 159 for my Cardinals. But I was over in London, I guess it was actually 2 summers ago now, where we saw the St. Louis Cardinals play the Chicago Cubs.
That's right.
My question for you now is, everybody in London now talking about Major League Baseball, and are people excited about the beginning of the baseball season?
I thought you were going to ask me what the scores were in those games, and I'm really terrible at remembering outcomes, unless it's an important one, right?
Right.
But the short answer is no.
Yeah.
I don't think it's really changed anything.
But I do really enjoy the fact that Major League Baseball is making the effort, along with me, to try to globalize the game.
I was surprised when those games happened, but people showed up.
Yeah. And obviously, particularly in Japan, where they were playing games, they're doing a lot more of that in Mexico as well. So I'm going to still continue to be a proponent for Major League Baseball around the globe, despite the feedback that I get from the listeners of the Cross-Border Tax Talks that have very little interest in baseball. So let's move on to topics that are maybe of more interest to our listeners. So I want to go, and we've alluded to this, Tom, on a number of different podcasts, and I finally have you here. You've spent a lot of time thinking about some of these provisions, and I've kept alluding, we're going to have a podcast on this, we're going to have a podcast on this. But to remind listeners, in a day one executive order, which is still kind of hard for me to wrap my head around, that there was a day one administrative order or executive order on international tax. So it was on January 20th, 2025, President Trump directed the Treasury Secretary, in consultation with the Commerce Secretary and the U.S. Trade Representative, to investigate whether any foreign country subjects U.S. citizens or corporations to discriminatory or extraterritorial taxes pursuant to Section 891, and to provide a report coordinated by the Treasury Secretary that is to be delivered by April 1st, 2025. So, Tom, you've been doing this a long time. I've been doing this a long time as a U.S. international tax practitioner. My first question is, did you know what Section 891 was when this came out initially?
I did. In fact, I read Section 891 a week before the inauguration, just to remind myself what it said in case, it happened to come up.
Well, you are ahead of me. So let's enlighten our listeners and viewers. What is Section 891, including a little bit of historical context?
Sure. It's a relatively short statutory provision. It was enacted about 90 years ago or so. And what it does is it gives the president some powers as it relates to foreign countries that have a so-called extraterritorial or discriminatory tax. So specifically, what it says is that if the president determines that a foreign country has a discriminatory or extraterritorial tax as it relates to U.S. citizens or corporations, and the president makes such a proclamation, then there's a certain doubling of tax rates in the U.S. code that happens. Now, no president has ever actually made such a proclamation before. Ever. I think President Nixon might have considered using it at some point, but that's the only president, as far as I know, that's actually considered it. it did come up. The reason why I was familiar with 891 in principle was that there was a discussion around the time the state aid cases were being heard, right, of whether or not the president might use Section 891 in that context, but again, never did. So,
and there was actually an article that was published that, frankly, I kind of looked over, I think, during the time, but then, because that's really sort of the one article, and by Professor Itai Grinberg, who was in the Biden administration at the time when he published that article and is now at Georgetown. That he wrote an article about that, but it's really, to what we were able to find, really like the only article or really anything written on this since the 1930s when this was introduced.
Right. And it predates a lot of almost all of the international tax rules, if not all of the international tax rules that we have. It predates all of our income tax treaties, for example. So it's really, in some respects, forging new territory, right, in terms of the use of Section 891.
So let's talk a little bit about actually how it operates. Yep. You talked about doubling of taxes. Unpack that and explain sort of how that. And then I know there's been some sort of technical questions, including questions we've gotten from some non-U.S. folks. Talk a little bit about how this provision actually operates.
Okay. So again, the provision says the president makes a determination that there's a foreign country that has an extraterritorial or discriminatory tax. There's no definition of those provisions. It does appear to be within the president's discretion to make that determination.
Of what is extraterritorial or discriminatory.
But now, of course, the president, as you said, in the executive orders, directed the Treasury to go study that and report back to him. And then the president must make a proclamation that that foreign country has that tax. And the effect of that proclamation is that for the tax year in which the proclamation is made, foreign citizens of that foreign country and corporations of that foreign country, presumably that means incorporation, but not entirely clear, are subjected to a doubling of the tax rate on certain amounts of U.S. income. So in essence, that's the income tax. So if you are, for example, a foreign citizen residing in the United States and subject to worldwide U.S. taxation on your income, so that rate doubles. And if you are a corporation, it subjects your, say, taxable U.S. branch incomes or USPE to a doubling of a corporate income tax rate. And it also applies to double the tax rate of certain payments of U.S. source income that we call fixed determinable annual or periodic income.
The DAP.
Thank you, Doug. That is a 30% gross tax collected through withholding. And so it doubles that tax rate as well, the income tax on that. The doubling of the tax happens every year. The relevant tax is outstanding, and it happens for the entirety of the tax year. So if the president were to make a proclamation in June, for example, on a specific country, and the relevant tax year is the calendar year, that would be the entirety of 2025, for example, that the doubling of the tax rate happens. And if the issue remains outstanding in 2026, then the doubling happens again, maximizing to 80%, so you can't go beyond 80%.
Yeah, so it doubles up.
Correct.
Right, every year until you get to 80%.
Which is generally going to take 1 year.
Exactly.
Right?
Like,
So,
I'm not that great at math, but that it's not going to take very long. You're going to get to that. You're going to get to that second year. Maybe a couple of points of clarification for listeners, and just to kind of reiterate, because this is a very big deal. First of all, it does not apply to those foreign non-U.S. parented groups that operate in one of these countries to the extent that they're operating in U.S. corporate form.
Correct.
The income that's earned by that U.S. corporation is not double taxed.
Absolutely.
But to your point that if you've got a non-U.S. a foreign non-U.S. company that is subject or that is viewed to be discriminatory extraterritorial, if they have effectively connected income, which they typically would in a branch, then that would be subject to double tax. And
Correct.
I think, frankly, one of the biggest issues and concerns are for those executives that live in the EU. Presumably, the UTPR is going to be considered a extraterritorial and or discriminatory tax. That would double the tax for those individuals. maybe just asking for a friend. What about dual citizens? Like, I don't know if people that maybe hold a passport in the UK and the US, for example, are they potentially subject to this rule?
Well, they are potentially subject to it because the way the statute is written is it refers to citizens of the relevant foreign country, and there's no specific exclusion of if you're also a U.S. citizen. So the application is not entirely clear. There are good arguments as to why it ought not to apply if you have U.S. citizenship, but I'm prepared to accept that it's not that clear.
I guess you might be keeping a close eye.
I am indeed.
Keeping a close eye on that.
Yeah.
So one of the other questions that we received is, does this technically apply to withholding taxes? And I don't want to get too into the weeds of the interaction of 871, 881, and 1441, but maybe if you could unpack that a little.
Sure. So the way our statute works is that there is this 30% tax that applies to payments of certain amounts of U.S. source income. So think dividends, interest, and royalties. It's more than that, but we'll just focus on those. So the way the statute works is that 30% tax, there's an obligation on the person making the payment of that income to collect the tax through withholding. And there is, if you will, an equivalent obligation on the payee to pay that tax. So if, for example, for whatever reason, the person making the payment doesn't withhold a sufficient amount, then the payee must pay the tax due, the unpaid tax due through withholding. Similarly, if they withhold too much, the payee can file a claim for refund. So the ultimate liability resides with the payee, even though there is this obligation on the person making the payment to withhold. And 891 itself does not address the actual withholding. The only the statutory provision in this context that it references is the payee's tax liability, so 871, 881. So what that means is, generally, if 891 were to apply, and I think we'll probably touch on treaties in a second.
Mm-hmm.
Just think about in a non-treaty context, the person making the payment would continue to withhold the 30% tax that they withhold now,
Mm-hmm.
and then the payee would have to file a tax return paying an incremental amount, 30% in the first year.
Yeah, and I think that's a very important point, because I think there were some that was like, well, doesn't that apply on the withholding, which technically it doesn't, but it doesn't absolve that recipient of that payment from the liability under Section 891. In fact, it just adds an additional compliance obligation that they may or may not otherwise have, that they will have to file a U.S. return.
That's right.
To make that payment.
That's right.
So you already teased this, but how does this reconcile with tax treaties? And we've talked about in the cross-border tax talks before, the U.S. rule, which is very different than I think a lot of other countries, in that we have this later in time rule. But remind listeners about the U.S. later in time rule, and then how does this 891 reconcile with that?
Okay, so what the later in time rule or concept is essentially that when we look at a conflict between our domestic law and an income tax treaty, typically what we do is we look at which rule happened later in time. So if the treaty post-dates the relevant law, then generally speaking, you would apply the treaty. If the statutory provision follows the treaty in terms of its enactment, and there is some clarity that Congress intended it to overturn a treaty, then that statutory rule prevails. And the scenario we have here is, this is 90-year-old statute. A proclamation by the president under the statute isn't creating new law. It was enacted essentially before all of our income tax treaties. So arguably, the later in time rule would say, look to the treaty as the right outcome, even if a proclamation was made. And arguably, this is kind of no different in a way to saying, let's say that we amended our 30% rate on this income to 35%, just for all payments, regardless of Section 891. Arguably, we wouldn't be running around worrying about the treaty at all. We would say that's relatively clear. You'd continue to apply the 5%, whatever the treaty rate is in that context, notwithstanding there's just been a rate change. And that's the function of Section 891. It says, look to the domestic rate in the relevant affected sections, double it, and in this particular context. So, and I think there are other arguments to say that, well, if you read the non-discrimination article in a treaty, that's designed to prevent taxation on the treaty partner that is more punitive than you tax your own citizens or
Mhm.
residents. And that sounds a lot like what might happen here for example, for an individual living in the United States who is not a U.S. citizen.
Yeah, I mean, and just I think the message is that there are a lot of nuanced, kind of interesting technical issues,
Yeah.
and we love to debate these issues. But I mean, the fact is, this provision has never been utilized
Yeah.
before, and we will see sort of how and if the administration decides to move forward with this. And these topics have been discussed publicly. I'm sure that President Trump's advisors understand what these issues are. I believe that may be one of the reasons that Congress has introduced Section 899, which we're going to come to here in a minute, which would obviously be later in time if this is new legislation.
Yeah.
But before we go there, I also wanted to just hear from you. On February 21st, we had another executive orders, just to kind of put the executive orders behind us, that was also related to international taxation, and I believe, frankly, was more focused on digital service taxes. But what did that say?
Well, in essence, what it did is it kind of amend the January 20th executive orders to say when you're considering what extraterritorial taxes are out there, and when you're considering the Pillar 2 rules, also look at digital service taxes when you do that, and sort of report back at the same time in the same report on digital service taxes as to whether digital service taxes are extraterritorial or discriminatory for purposes of our code. There's one point on the treaty that I kind of want to go back to in a second,
Yeah.
which is that I think that the technical analysis, if you will, you look at the later in time rule, you look at the words of the relevant treaty. I also think it's important to take a step back here in terms of the context as well in which these provisions might be invoked, right? So if we have a foreign tax that is being identified as a discriminatory tax, for example, what does that mean in terms of the kind of bilateral relationship in the treaty itself, right? So I think I think when one looks at how the treaty works, it's best not to just focus on how our domestic law works, but also consider the environment that we're in and the dialogue that's happening, and in terms of how this might get looked at.
Yeah. And maybe before we go to Section 899, kind of in this context, and particularly in light of the February 21, so we're expecting this list.
Yep.
We don't know if it's going to be made public. We're recording this in early April. We have not seen this at this point. We'll decide if it goes public. But in that first executive order specifically really focused on Pillar 2, and we've talked about this on the podcast, that President Trump was focused on the UTPR applying to U.S. parented groups and subsidiaries, foreign subsidiaries of U.S. groups. I think that was kind of the new horse in the race, so to speak, that we hadn't seen from a policy perspective. One of the issues that I foresee with this February 21st and now sort of adding digital service taxes to the whole mix is if we end up with the list of DSTs and UTPRs, does that potentially discourage those countries that have implemented both from negotiating on them separately? In other words, does it disincentivize a particular country from saying, okay, well, we'll be willing to agree to changes with the OECD and exempt or make the UTPR safe harbor permanent, maybe make guilty a qualifying income inclusion rule. But if they make those changes and they still have a digital service tax that are in the soup, it feels like it potentially causes those what could be separate issues to conflate and presumably makes the negotiations harder. I have no idea how any of this is going to play out.
Yeah, absolutely. No, I think that's a good point because on the UTPR itself, it's also unclear who do you negotiate with on that, right? So like, where is the dialogue on that? Because again,
great point. Is it the country? Is it the EU? Is it the OECD?
Correct. And I think in some respects the EU directive is what makes the UTPR discussion,
I agree,
more challenging than it first appears, right? So if you start off with like, there's the UTPR safe harbor. Can we do things to the safe harbor to make it permanent? Can we extend it, et cetera? But anything that deviates beyond the safe harbor where it might require a model rules change, that becomes a lot more difficult in the context of the EU directive on Pillar 2 that effectively requires unanimity within the EU.
Yeah, all 27 member states would have to change it.
That's right. So, and then you have on the other hand DSTs. That's a country by country issue. So I think it is important to bear in mind that you only need one of these one tax that is extraterritorial or discriminatory to have an issue. And to your point, could it be possible that you fix your UTPR and you find you just still have the problem on the DST, and DSTs are then that's because that's country by country. What's the time frame of that? Who goes first, who goes last? Is it simultaneous? But obviously DSTs can vary from jurisdiction to jurisdiction. So it might even take Treasury a bit longer to identify all of the relevant DST jurisdictions, given it is a country by country approach.
Right.
Whereas the UTPR, you can kind of look at the model rules and
Well, you can
make
just
it clear.
or go to the PwC Pillar 2 Country Tracker
That
and
is
you
true.
can figure out which countries have implemented the UTPRs, which I
Correct.
would encourage all listeners, including those in Congress and in the administration, to check out. All right. So I want to move to 891 or 899. And the way I kind of describe 891, this is a terrible analogy, but I'm going to throw it out there anyway.
Go for it.
891 is a sledgehammer and 899 is more of a scalpel. But I feel like that's being a little generous to 899. But let me give a little bit of background. We've actually talked about this because this was proposed last year before the Trump administration, which we knew was going nowhere, and then was recently reintroduced. And it's called the Defending American Jobs and Investment Act. And it's a new section 899 that would pose additional taxes on certain income earned by citizens of or corporations formed in or tax resident in jurisdictions that have a tax regime considered discriminatory or extraterritorial in relation to U.S. citizens or corporations. So let's talk about how does 899 work? It is a much longer code section with definitions and everything else, but and maybe again less of a sledgehammer and more of a scalpel. But tell us about 899.
Well, I want to start with there's the first question that is begged as to why do we need 899 if we have 891, right? So the fundamental starting point on both 899 and 891 are very, very similar. There is an identification of a regime that has a tax that's considered extraterritorial or discriminatory as it relates to U.S. citizens or corporations. Now, 899 defines those terms. 891 does not. But 899 requires Treasury to maintain a list of those jurisdictions, which I would argue is not that different than the president issuing an executive order, right, to identify the relevant countries. So the starting point is very, very similar. Treasury's involved. There's a list or countries that are identified. Why do you need 899? The most logical argument appears to be the treaty analysis, right?
Later in time.
That it's clear, Congress has the opportunity to, enact legislation that postdates treaties and the opportunity to state their intention as to what aspects of it, should be considered to override or overrule, if you will, a treaty conflict.
Does it explicitly do that?
It does explicitly do that. At the moment, the current draft or the latest draft does that only for the withholding amounts and does not do that for the substantive tax. So it's arguably slightly the other way around as compared to 891, which doesn't mention the withholding at all and only deals with the operative tax. The treaty override, at least in the statute as it stands right now, only applies to the withholding. So, we'll see if there are modifications to the statute over time.
And I will note again, this is a proposed bill. So there's a question of, well, where does this proposed bill potentially fit in as part of the Trump legislative agenda? Does this go into the tax package? Does this become some sort of alternative bill that goes out? And there's lots of sort of procedural and technical questions that we're not going to get into. Does this generate revenue that can go through the reconciliation process?
Yeah.
So there are a whole number of kind of procedural and technical questions, but the important piece is that this is just proposed legislation. It was proposed last year, but it does appear to at least address the treaty issue, and it is just a proposal, and so that the rules the wording could change. But talk about how it operates, because 891 doubles the tax. How does 899 work?
So the first step is for Treasury to prepare this list, and then what happens is for the first tax year beginning after 180 days and 1 day after the list is issued or your country goes on the list, so that for that first tax year there's an incremental 5% tax that applies to certain types of U.S. income. This is narrower in its approach than 891, so it does not apply to any U.S. citizen. Any U.S. resident, I should say. Doesn't apply to
Dual residents?
does not apply to dual residents, dual citizens,
or dual
even.
citizens, I'm sorry.
So it's really intended to focus on the U.S. source income, the 30% tax on U.S. source income, with a couple of additional items. But it's narrower in scope. It adds an extra 5%, again, for that first tax year beginning after that 180-day period. And then it adds an incremental 5% every year thereafter until capping out at an incremental 20%. So that gets you to an aggregate 50% tax, right? If you take the 30% tax plus the 20. So if we sort of play that out a little bit, and let's say Congress adopts 899 this year at some point, and then Treasury identifies a country on a list, you go 180 days forward, and let's say that 180 days ends sometime in February 2026. The way this is drafted would say then the substantive tax of the 30% tax plus the incremental 5 would start from 2027 for calendar year taxpayers. So there's a lot longer of a tail associated with it. I think one of the things we didn't touch on 891 was the fact that if the offending tax is repealed by the foreign country, the president can make a second proclamation saying the tax has gone away, but that does not undo 891 until the following year. So it's quicker in terms of its application and kind of heavy, if you will, straight away. 891 is compared to 899, which has more of a transition period before the tax applies, and then it spreads out the impact over an incremental 4 years.
The 5% incremental tax, what about for those countries that have an existing treaty? So this is a common question I've got. Do you add 5% to the treaty rate, or does it effectively override the treaty and you're at the full 30% plus the 5%?
Well, it's rather confusing, actually, I think, in terms of the way the rules are laid out at the moment. So, and in part because the effective date for withholding tax purposes under 899 is different than the effective date for the substantive tax liability on that same payment. So the withholding rate would go up essentially when that 180-day period has expired. So let's take my example again, where the 180 days runs out in February of next year. So starting from that point, you would start withholding 35%. So you would just ignore the treaty rate, take the domestic rate, and add 5, and apply that. There is then the legitimate question to answer of like, well, how do I? If I go back to it's the payee that has the substantive tax liability, and you measure it at the payee level, and that tax doesn't start until the following year, how does this all hang together? I mean, this is an area where I think there's probably would be some clarification as this bill made its way through the legislative process if it was enacted.
Yeah, the other thing, and I mean, we could spend a whole podcast on this, is that the Section 899 does define what an extraterritorial tax is, or at least gives a definition of that, and a discriminatory tax.
Right.
I mean, my takeaways from that is that the extraterritorial tax was really designed to hit the UTPR.
Yeah.
And the discriminatory tax was really designed to impact the digital service taxes. But I will acknowledge, and some others have written and talked about this, that, I mean, depending on how you read that, it could be read more broadly than, frankly, just a DST. But this really is just guidance that Treasury needs to use for purposes of identifying, whether somebody ends up, I've been calling it the naughty list. But any additional thoughts or takeaways with respect to those definitions that were provided?
Well, the UTPR, the extraterritorial definition, the reason why we say it's looking like the UTPR, it's like, is it a tax that applies to a related person's income without regard to an economic or ownership interest, right? So the income is somewhere else in the group, but not under your own ownership, right?
Can't think of really many other taxes that are like that. Maybe a couple, but
yeah. So the what is a discriminatory tax is a little less clear, I think, and I just think that's an area where we just need a bit more guidance as to what technically meets the definition. Now, at the end of the day, it's within Treasury's bailiwick to put a tax on the list, right? So it's not taxpayers that have to figure out what is a discriminatory tax. It is the Treasury that does so.
All right, so I want to move on to this potential changes to the beat, but maybe just to put a bow on Section 891 and 899. And hopefully it was a good overview for listeners. We're obviously going to keep an eye on. I mean, we have this administration is obviously it's very hard to predict what's going to happen. I mean, this is all sort of new issues. So very interested to see if we get that published list of the naughty countries, whether 891 is actually imposed. Certainly we'll cover that as we get more. Yeah. But really, we wanted listeners to sort of have an understanding of 891. That is current law, and then this proposed 899. So sort of along the lines of potential future changes in legislation, on March 27th, the House Ways and Means introduced an additional bill that would retaliate against foreign countries that impose, again, extraterritorial taxes, such as the UTPR, that could have significant changes to our base erosion and anti-abuse tax, or BEAT. So tell us a little bit about that. What is that code provision? What is that proposal, I should say? Tell us.
Well, first thing I'll say is it's only focused on extraterritorial taxes, right? Yeah. So the discriminatory issue is not there. There is a definition of extraterritorial tax. It is effectively the same or very similar to the definition in 899. Is it a tax that applies to a related group company's income, regardless of ownership or economic interest? So again, I think it appears to be fairly squarely aimed at the UTPR. In fact, I think the UTPR is referenced in the press release for it.
It is. The Unfair Tax Prevention Act, I failed to mention, is what it's called.
I hadn't quite
put... UTPA.
I had not quite put that together.
All right.
So the way it would work is that if there is a foreign country that has an extraterritorial tax, and that determination is not done by Treasury in this context, that is done by the taxpayer, and you have a U.S. entity that is owned by a foreign entity that has that extraterritorial tax, then there are certain modifications made for that U.S. entity to the BEAT rules. So maybe level setting a little bit, the way BEAT works is it's a minimum tax regime in the United States that requires a recalculation of modified taxable income multiplied by the relevant BEAT rate, and if that amount exceeds your regular tax, you have to pay an incremental tax amount that is the BEAT. There are certain exceptions in the BEAT rules in the statute itself for payments that are that would otherwise be adjustments for purposes of modified taxable income. This bill or this proposed law would switch off those exceptions for affected U.S. companies. So again, U.S. company owned by a foreign country with that tax regime.
And that's a 3% base erosion percentage floor, and then this $500 million gross receipts test.
Well, and also the things like the services cost method would be eliminated. And the other proposed change for the BEAT rules in this context is that 50% of the cost of goods sold of that U.S. company is treated as a base eroding item for purposes of the BEAT rules, and therefore for a BEAT adjustment. Now that is interesting on a number of levels. So first of all, to date, cost of goods sold essentially does not get picked up as a base erosion deduction because it's a reduction to gross revenue. It's not a tax deduction, if you will, under the way the U.S. rules work. So it is not an add back for BEAT purposes. So this would impose an add back. But the way that statute is written right now is it doesn't matter who you make the payment to, which the BEAT rules generally do. They look at, are you paying a related foreign person? That's within the purview of the BEAT rules. This would include 50% of cost of goods sold, regardless of who the payment is made to. So a significant shift, if you will, in terms of some of the principles of BEAT.
And we're not sure if that was intentional or maybe that was sort of drafting. Again, these are all proposals.
Right.
And we've been through this process as U.S. practitioners.
Right.
And I know sometimes outside the U.S. they'll look at this and be like, oh my goodness, this is what this says. And I just want to caution listeners that is what it says.
Yeah.
But it is still early in the process. And there wasn't like history, or we don't know sort of if that was intended or not.
And I think again, let's maybe take a step back and say, well, why do you need something like this, right? And we've got 891 on the books. We might have 899 go on the books. We might not. And then we have this other approach to deal with extraterritorial taxes. 891 and 899 are obviously a very different approach. That's taxing non-U.S. persons. So the entities that are bearing the cost of the retaliatory measure is a non-U.S. person, and there's some level of how do those rules even work together if they're both live, 891 and 899, but it's all at the non-U.S. person's level, with a lot of complexity in terms of how you calculate the amounts and dealing with treaties, etc. This is simply, I think, looking at it from the perspective of, well, administratively, the way we could approach this more cleanly is to collect that tax.
We being the U.S.
Sorry, we being the U.S. Is to collect that tax from the U.S. entity itself. So that becomes a cost of the U.S. business.
Yeah.
So query does that.
It's an administrability issue.
It's an
right?
administrability issue. So I don't think we think it's, I think one of the things that could get in the way of that kind of approach is the impact of it actually being the cost being borne by a U.S. business.
Right.
Is that something that Congress feels like is the right tool, or is the other, are the other tools appropriate? And I think what it really represents in some respects is it's not that all of these rules definitely are going to happen.
Right.
They all might happen, but what we're seeing is some thoughtfulness of what are the variety of ways in which the Congress might retaliate, against an extraterritorial tax. We may see other proposals that come up in terms of different approaches as to how.
And I feel the same way, that these feel like alternative mechanisms to be able to go after sort of those countries that have implemented the UTPR, for example. Yeah. But it is also possible that both of them could get passed. Yeah. And so, I mean, with all this uncertainty, Tom, I'm not going to ask you where this is headed, because none of us know where this is headed. Yeah. But any practical advice that you have for taxpayers, and I'm going to start with one, is like, particularly in the U.S., get involved in the process for taxpayers. Yeah. I mean, like, to the extent that, one of these approaches may be better, but, I think one of the things that makes the U.S. legislative process so unique, particularly as we're sitting here in Europe, and maybe some of this is changing, is the ability and the desire for those on the Hill, so to speak, those in D.C., to want to engage with taxpayers, want to engage with those that are doing business in the U.S. And this is obviously a very important year for those doing business in the U.S., where we know we're going to have a new round of U.S. tax reform with Tax Cuts and Jobs Act expiring. So my first piece of advice would be for those even non-U.S. multinationals that maybe are less comfortable with that process, to get involved, explain how you are, have jobs, and what you're doing to benefit the U.S. economy. But what advice do you have?
Well, I mean, I agree with that. I mean, let's start with the individuals for in the first instance. And we think about 891, if you have U.S. residents that are, paying their taxes and, spending their money and living in the United States, just as a general matter, affected by a Section 891 proclamation, that should be, flagged as a potential
give those
issue,
executives
right? So,
the heads up if you're a tax professional.
Well, first of all, give them the heads up, and I think also feeding back into your local representatives or whoever that who could be affected by that, right?
Great
And how many people could be affected by that. I think from a corporate side, in some respects, overall, it's don't panic. I think it's, there is, we need to see how this plays out. There are things that are beyond, the corporate's control. And in other words, like what is designated as an extraterritorial tax and what happens in the relevant jurisdiction to fix that or not, that is beyond your control, other than, flagging on the non-U.S. side, I think, as well, what impacts this could potentially have. So I think kind of, as the U.S. and kind of, again, whoever is negotiating this, whether it's the UTPR or the DST, kind of get to the table, I think it's important for both sides of that to be well informed as to really the reach of some of these provisions and the potential impact of it, so that they can be thoughtful as they go into it.
Great advice. Well, as these developments occur, we'll bring you back on the cross-border tax talks. I'm actually going to be in London in a few weeks. We'll see how quickly all of this, because I'd love to do one on your home turf there. We've got St. Louis and Prague now.
We can talk about football.
And we can talk about your Arsenal.
Yeah.
That you're a huge fan of, and I know less about football than you know.
I can ask you some
baseball.
football questions to start.
Oh boy! All right. Well, Tom, thank you very much. Always a pleasure having you on. And this is a fascinating area, and I think there's certainly going to be more to come.
Great. Thanks, Doug.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Tom Patten, PwC International Tax Partner based in London. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.